Hello there. I'm real estate economist Matthew Gardner. I'm delighted to welcome you to my new video series. Every month, we'll explore some of the latest trends and issues that are impacting the US housing market. On this first episode, we're going to take a dive into what is unarguably a crucial component of the ownership market: mortgage rates. The latest data I have suggests that around 62% of ownership housing in America has a mortgage, and of that share, about 88% use 30-year fixed-term loans. In total, lenders hold about $13.5 trillion of mortgage debt, and that's backed by housing worth roughly $48 trillion. Now, I always think that context is important, so let's take a quick look back at how the mortgage product that most of us use today first came about. By the way, did you know where the word mortgage came from? It actually comes from two Latin words, mort and gage. Mort meaning death, and gage meaning pledge. So mortgage is nothing more than a death pledge. But I digress. Fixed-rate mortgage products have been around since the 30s and 40s via the Home Owners Loan Corporation, the Federal Housing Administration, and Fannie Mae. However, it was during the 70s that the 30-year mortgage really started to dominate the market. The primary reasons for this were that housing demand from baby boomers, well, they wanted more expensive housing. It had grown to an extent that there simply wasn't enough capital to go around. Because of this, in 1970, Congress created Freddie Mac as an organization designed to increase the amount of capital available to mortgage lenders and, by extension, to home buyers. So, in April of 1971, the 30-year mortgage as we know it today was born, and the interest rate in that first month was set at 7.31%. How did they decide on the rate? Well, they based it on the interest rate for 10-year bonds. You see, at that time, the yield on the 10-year was 5.83%, so they took that and added a 1.48% premium to cover the cost of capital, as well as to account for any default risk. But why base mortgage rates on 10-year and not 30-year bonds, you might ask? Well, it's because the expectation was that homeowners would move, on average, once every 10 years. Now let's take a quick look at how rates have moved over the past 50 years. From an initial rate of just over 7.3%, rates were pretty volatile in their first decade due to inflation, and that drove bond yields and mortgage rates higher. And the spike in '79, that happened as the Federal Reserve started tightening monetary policy to get a handle on inflation. The 80s started off terribly, rates peaking above 18.5%. But as inflation started to fall, so did mortgage rates, which dropped to an average of around 10% toward the end of the decade. Rates fell further following the 1990 recession, and, even with the spike in '94, the age of the internet created strong economic growth, and rates dropped into the 60s. But that growth led to inflation, which again pushed borrowing costs higher. Unprecedented fiscal, monetary, and regulatory stimulus following the 2000 dot-com crash saw rates drop below 6% for the first time on record, and toward the end of the decade, they fell again with the bursting of the housing bubble and global financial crisis. To support economic and housing recovery in the US, the Fed started buying mortgage bonds in 2012, and that pushed rates down even further to 3.35%. But when they stopped buying in 2013, rates rose again. And that brings us to the 2020s, a period where we saw some of the wildest rate movements ever due to the pandemic. At its onset, rates started to fall because nobody really knew what the impact of COVID would be. Therefore, investors dived into the relative safety of bonds, but it didn't end there. To stabilize the economy, the Fed resumed quantitative easing, and they became the de facto purchasers of mortgage-backed securities. And it's because they really didn't care about making money, they accepted very low returns, and that was how rates fell to an unheard of low of 2.77% in August of 2021. But when the Fed announced that they would stop buying mortgage bonds, rates skyrocketed, with home buyers seeing borrowing costs double in less than 9 months. So that's the history lesson. But what does this all mean going forward? Well, we're going to get there in a moment, but before we do, I just want to correct the widely held belief that the Federal Reserve controls mortgage rates. They don't. Of course, they certainly influence them, but that doesn't mean that a Fed rate cut automatically leads to lower mortgage rates. And to prove my point, this chart shows 30-year mortgage rates and the Fed funds rate over the past quarter century. Can you see a solid correlation? I can't. But when you put the 30-year alongside the average rate for 10-year treasuries, well, things certainly line up a little better. Now, I'm not saying that the Fed changing monetary policy has no influence on mortgage rates. But what I am saying is that the two don't necessarily go hand in hand. Moving on. This chart shows a spread between the monthly yield on 10-year treasuries and the average rate for a 30-year fixed mortgage. Between 2000 and 2019, the spread between the two has averaged around 1.75%. Interestingly, that's pretty close to the spread that we've seen all the way back to 1971. Of course, there were periods when that spread tightened, but it's periods when the spread grew that are more interesting. The 07-08 spike you can see was because of the housing bubble bursting, and the 2020 spike was due to COVID. But you'll notice that on both occasions, the spread normalized very quickly. However, the final spike you see, due to the Fed getting out of the bond buying business, well, it's not retightened anything like as fast as normal. And, in fact, it still remains elevated. There are several reasons why this is the case. Slow demand for mortgage bonds and tight credit being just two. But the most interesting to me is that bond investors are demanding a higher rate of return. Why? Well, they believe that at some point, mortgage rates will drop. Borrowers will refinance, and that could cause the value of the underlying bonds that they own to fall. And because of this, the spread between bonds and mortgage rates remains elevated, because it's essentially covering potential mortgage prepayment risk. But you did see that the spread has softened, which has allowed mortgage rates to drop more than the relative fall in 10-year Treasury yields. Now, having seen this happen already, I think it's reasonable to believe that even if bond yields stay exactly where they are today, the spread between mortgage rates and treasuries can still close a little. And that means homebuyers, well, they could see mortgage rates fall from where they are today to a level closer to 6%. Now, is a 6% mortgage going to make the market happy again? Of course it won't. And we already know that there are still a lot of people sat on the sidelines waiting for rates to drop back down to the levels we saw in 2021. Now, as far as I'm concerned, they're going to be waiting a very long time. You see, I believe that the terminal or long-term interest rate for 10-year treasuries is around 4%. And if we return to somewhere close to a normal spread, well, the maths suggests that mortgage rates should move down to an average somewhere between the high 5s and low 6s over the long run. Now, could there be times when rates fall below that? Of course there could. When the country experiences a period of economic contraction, well, then I'd certainly expect to see bond yields fall, and that will push down mortgage rates. However, it will only be temporary. And ultimately, it's going to return to that level that I think is where it feels comfortable. But a word of caution. I continue to worry that unless the government gets a handle on spending, well, the national debt will continue to rise, and that could easily push bond yields higher, and therefore mortgage rates will end up higher over the longer term. But all that said, my current forecast is for mortgage rates to end this year modestly closer to 6% than where they are today, but we could see them fall below 6% at some point in 2026. For those of you who are thinking of buying a new home, even at today's prices and borrowing costs, it's certainly worth remembering that America is unique when it comes to mortgage finance. Although I certainly don't advise buyers to over-leverage themselves in order to get a new home, but it's worthwhile remembering that the US is the only nation where you can borrow funds to buy a home with a 30-year amortization at a fixed interest rate and with no prepayment penalty. And that's a huge advantage to buyers because over the long term, household incomes tend to rise, but their mortgage payments won't. And this means that the share of household incomes that they dedicate to monthly mortgage payments does what? It goes down. And that alone is pretty compelling. So there you have it. That's my take on the US residential mortgage market. I really hope that you found my comments to be of some interest, and if you did, you can subscribe to my videos below. I'd also love to know what you think about this topic, so feel free to leave any thoughts you may have in the comments section. And if there's a subject you think I should cover, let me know that as well. So until we see each other again, take care. And I'll be back next month to take on another topic that's of interest to real estate professionals and their clients. Bye now.